All right, welcome to the Explainer. Today, we are zeroing in on, literally, the most transformational accounting standard the insurance industry has seen in decades, IFRS 17. Now, if you follow financial reporting, you already know this standard has completely overhauled how insurers present their financial health. But to truly grasp the impact of this massive shift, we've got to understand its beating heart. We're going to break down the mechanics, the logic, and the real financial impact of this new standard. So, let's jump right in.
Let me ask you something right out of the gate. Out of all the incredibly complex terminology, the hundreds of pages of rules, and, well, the decades of development that went into IFRS 17, what is the single most critical acronym that has emerged? Like, what's the one metric that every investor, analyst, and insurance professional absolutely must understand to gauge future value?
Well, it's the CSM, period. If you're looking at an insurance company's balance sheet today, the CSM is the absolute key to the whole shebang. It completely changes how we view profitability, how we project future earnings, and how we compare one insurer to another.
So, what exactly is it? Well, according to the Institute and Faculty of Actuaries and Grant Thornton, the Contractual Service Margin, or CSM, fundamentally represents unearned profit. Simply put, it's the profit an entity expects to earn as it provides insurance contract services over time. Think of it kind of like a giant reservoir of future earnings that a company has secured but hasn't actually delivered the service for just yet.
Okay, Section 1, the end of day 1. Shifting from IFRS 4. To really appreciate why this is such a game changer, we have to look at the main problem the CSM was designed to fix in the first place.
Under the old rules, IFRS 4, there was a pretty glaring flaw in certain jurisdictions, and that was the immediate recognition of profits. In the old days, some companies would recognize all their expected profit the exact moment a long-term policy was sold. Essentially, insurers were recognizing their whole paycheck before they'd even done the work of actually providing the coverage over the years. I mean, must be nice, right? Well, IFRS 17 steps in and says, yeah, not so fast. It strictly mandates the systematic deferral of those profits.
And you can see the real-world impact right here. As Manulife points out right at the top, the change in the accounting standard doesn't actually impact the underlying fundamentals or the economics of their business. The cash they generate, that's exactly the same. However, what is completely transformed is where, when, and how specific items are recognized. The CSM is introduced to explicitly defer the recognition of new business gains over the lifetime of the insurance contract.
So the crucial takeaway here is this principle of deferral. When an insurer writes profitable business today, they are forced to avoid that day one recognition. Instead, those new business gains get parked directly on the balance sheet as a liability. That's your CSM liability. It represents a real obligation to provide future services, and the profit is only gradually released over the life of the contract as that service is actually rendered.
All right, moving on to Section 2, Under the Hood, how the CSM works. Now that we know why it exists, let's look at how actuaries and accountants actually calculate this vital metric when a new policy gets sold.
It all kicks off with the initial measurement at the very beginning of the contract. Step 1, you take the present value of all expected cash inflows, so mostly the premiums the policyholder is going to pay. Step 2, you subtract the present value of all cash outflows. Those are your expected claims and expenses. Step 3, you subtract a risk adjustment, which accounts for the uncertainty of those non-financial risks. And finally, if you still have a positive number after all that actuary math, congratulations, you've got a profitable contract. That remaining amount is your contractual service margin.
The illustrative balance sheet for Manulife we're looking at visually anchors that math perfectly. Over on the right side, under the new IFRS 17 basis, you can see exactly where the CSM sits. It's stacked right next to the current estimate of cash flows and the risk adjustment. Combine those three blocks and you've got the total liability. Notice how the CSM totally replaces the old retained earnings and equity blocks that used to just pop up immediately under IFRS 4. Interestingly, at transition, establishing this massive new liability actually caused a decrease in initial equity for a lot of insurers, simply because those profits were moved back onto the balance sheet to be earned later on.
But how does that profit actually make its way back onto the income statement? Well, it happens through a systematic release or amortization based on what are called coverage units. Take a look at this 5-year term assurance contract modeled by the Institute and Faculty of Actuaries. The insurer projects the coverage units, which is basically just the quantity of insurance service provided each year, and calculates an amortization ratio. So in year 1, they provide 25% of the total expected service, which means they get to drain 25% of the CSM liability and recognize it as profit in their P&L. By year 5, that liability is completely drained down to zero.
I really want to reinforce this with the direct quote from our sources because it's absolutely fundamental to how modern insurance accounting works. The CSM represents unearned profits that are expected to amortize into income over time. This gradual release, that is the newly installed engine of an insurer's reported earnings.
Which brings us to Section 3, the exception. Onerous contracts and losses. Look, in insurance, not every contract is a winner. So we've got to address the strict asymmetric exception built right into IFRS 17. What happens when a contract is expected to lose money right out of the gate?
The standard dictates a very deliberate asymmetric treatment of losses. While profitable contracts generate a CSM to defer gains, loss-making, or onerous, contracts generate a CSM of exactly 0. You absolutely cannot have a negative CSM to hide bad news. No way. If the expected outflows exceed the inflows, the insurer isn't allowed to spread that loss out over time. Those expected losses have to hit the income statement immediately.
The IFOA diagrams here contrast the two scenarios perfectly. On the left, the profitable group has that nice, healthy CSM block sitting right on top of the risk adjustment and cash flows. But over on the right, for the loss-making group, the CSM is completely wiped out. In its place is an immediate loss component. It's a harsh reality check for sure, but it's specifically designed to give stakeholders immediate visibility into bad business.
All right, last part. Section 4, the analyst perspective, predicting future value. We've covered the mechanics and the exceptions, but let's bring this all back to why it actually matters to the broader financial world. Why does this metric completely change financial analysis?
Honestly, analysts really appreciate this shift. Because profits are no longer front-ended, financial statements have dramatically enhanced transparency. By tracking the CSM, analysts can see exactly how much unearned profit an insurer has stored up in the tank. More importantly, the movement in the CSM, like how much it grows from writing new business versus how much gets released into revenue, reveals the true sustainable earnings engine of the company, completely stripping away a lot of that short-term noise.
Which brings us to this big concluding insight, echoing the perspective of industry leaders like Manulife. If you want to know the future value of an insurance business, look at the movement in their CSM. It is literally the ultimate compass for valuing an insurance company under IFRS 17.
So we've seen how the contractual service margin takes those old day-one gains completely off the table and replaces them with a transparent, systematic release of unearned profit over time. I'll leave you with this. With this unprecedented transparency into the actual engine of earnings, how will tracking the CSM change your view on the true long-term value of insurance investments? Definitely something to think about as you look at the next set of financial statements. Thanks so much for joining me for this explainer, and as always, keep learning.